Stock markets are wobbling again, and yet the consensus for 2022 is an environment that should be supportive of equities. Many investors expect higher growth to support higher yields, such as the US government 10-year, which is currently breaking out. At the same time, the market anticipates an end to QE by March, the beginning of the rate hiking cycle in the same month, and the potential for quantitative tightening by the middle of the year. The consensus for price action today is, however, at odds with recent history. So what are the risks that yields and growth surprise to the downside in 2022? Well, that's the big conversation. Inflation is driving a tightening narrative that makes previous efforts by the US Federal Reserve look incredibly tame. The sequencing of QE, rate hikes, and then quantitative tightening took place over a significant time during the last decade. The taper tantrum in 2013, when the Fed announced a strategy for ending its bond purchases, saw bond yields scream higher, even though its bond purchases were still in full swing. The actual tapering of the purchases took place over the following year. It was a further year before the Fed first increased interest rates. Quantitative tightening, when the Fed reduced its balance sheet by $50 billion of assets per month, began in earnest in 2018. By the end of 2018, the equity market had a wobble, leading to the Fed ending its rate hikes and halting the sale of assets from its balance sheet by the middle of 2019, which it actually started increasing again during the repo crisis. But the process took 5.5 years from taper announcement in 2013 to that 20% decline in the S&P in 2018. This time round, the time between the taper announcement last year and the beginning of quantitative tightening could be as little as 1 year or less. And as it currently stands, that's a significant change in a very short amount of time. And of course, the Fed's been forced to act by the multi-decade highs in inflation. But what are the chances that the Fed will be able to fulfill all these initial expectations and go all the way from balance sheet expansion right now to balance sheet contraction within a few months? Today, even as they talk a good tightening talk, they're still in easing mode. But with the general consensus for 2022 being one of growth and inflation, much of the expected growth in the economy has already been priced into the market. Therefore, strong growth in 2022 would not be a shock, but weaker growth would. So if we are now looking at a withdrawal of liquidity, or at least a tightening of policy by the Fed, then we should look at how assets performed when policy was loose over the previous 2 years. Bond yields rose from March 2020, whilst real yields declined. Now, real yields are nominal yields minus inflation expectations. When we look at the breakdown of the 5-year yield, we can see that inflation expectations led the way, surging from the March lows. Nominal yields hardly moved, so that real yields were driven much lower. Eventually, nominal yields started to rise, but were largely offset by inflation expectations, so that real yields remained subdued and supportive of risk assets. But what was the main driver of inflation expectations? Well, it looks like the expansion of the Fed's balance sheet was largely to blame. Or more directly, the Fed's balance sheet was expanding in part because it was buying up the TIPS market and pushing inflation expectations higher. Now, other factors were at work, such as the rebound in oil prices, which also supported inflation expectations. But the Fed's balance sheet was certainly a major influence. Therefore, if the Fed's expanding balance sheet helped to drive up inflation expectations and nominal yields, then surely a decline in the influence of the Fed's balance sheet should have the reverse effect and put downward pressure on inflation expectations and yields. But sequencing remains key. As of right now, the Fed's balance sheet is still expanding, and as we shall see shortly, this does support higher yields for now. Furthermore, we don't expect the balance sheet to shrink until the second half of 2022, so that downward pressure on inflation expectations from an unwind is still quite a few months away. And finally, this is still a global picture. The ECB is still in QE mode, and its balance sheet expansion has been accelerating. But as we saw in the programme last week, when QE is in full flow, bond yields tend to rise. When QE is non-existent, bond yields have fallen. Soon the Fed will end its QE operation. Whilst that's not a complete ending of global QE efforts, the direction is clear, and it has only needed periods without QE, rather than outright QT, to see bond yields fall. Therefore, we may be entering a period in which, based on past history, growth and yields are under pressure. Prior to that, we still need to negotiate the end of the Fed's loose policy, which still remains supportive of higher yields for now. But the activity in the yield curve provides some additional clues. Yields are rising at both the front end and the back end. The US 2-year 10-year yield curve has been marginally flattening. This is suggesting that the outlook for growth remains weak. At the same time, the front end of the curve is getting steeper. 2-year yields are rising faster than both 3-month and 10-year yields, pricing in higher rate hikes over the next 24 months. And have we now seen a peak in the 2-year, 10-year portion of the yield curve? Previous peaks have been much higher, around 250 basis points versus 160 basis points today. So has the business cycle therefore been accelerated and shortened by the policy response? And the US is now starting to show some tentative signs that the recovery is starting to run out of steam. The recent Empire Manufacturing Survey has dropped into negative territory. If we exclude the COVID crisis, these are levels usually associated with soft patches, like the manufacturing recession of 2015 and 2016. Whilst headline inflation remains extremely elevated, the prices paid section of the ISM Manufacturing Survey has significantly declined from previous months. Compared to CPI year on year, prices paid tends to lead, and the current move is reminiscent of the rebound and then rollover that we saw during the recovery from the GFC. In fact, high and rising levels of inflation often preceded recessions, and higher oil prices in particular have often been a regular occurrence into many of the recessions of the last few decades. The Baltic Dry Index is also sliding lower after a spike during the previous year. This could be a result of falling shipments due to problems in China, or it could simply be that bottlenecks rather than excess demand were behind the rise in prices last year. And we've documented before how the global economy was struggling prior to the pandemic, with most of the economic growth centred around the US consumer. Whilst many expect Europe to play catch-up once COVID has subsided, the starting point is still one where Europe's recovery has been relatively sluggish. Whilst US imports have recovered their pre-pandemic levels, the same can't be said of Europe, where imports are still well short of the equivalent levels. And looking further afield, we can see weakness in some of the cyclical markets that should normally be performing well if we were in a genuinely strong economic environment. Japanese equities can usually withstand high yields, but the recent move has not been matched by stocks, suggesting that the rise in yields is not a reflection of true underlying growth. The Korean equity market has also struggled, despite being a beneficiary of global growth. In Europe, the industrial sector is another that should benefit from improving expectations of growth. In absolute terms, the sector has recently made an all-time high, but when we look at the sector on a relative basis versus the broad Stoxx 600, the sector appears to be breaking down through a topping formation. One sector that does appear to be performing well on a relative basis is the European banking sector, which benefits from rising bond yields. The absolute and relative performance of the Eurozone bank sector has ebbed and flowed with the move in yields. High yields and steeper curves are generally beneficial. But those high yields are a double-edged sword for European banks. They benefit from that improvement in net interest margins. But at the same time, rising yields put pressure on debt servicing requirements. European banks haven't addressed their legacy debt issues, so improvements in income from steeper yield curves will not pay down the debt, and eventually high yields will become an impediment. And whilst European equities are currently just about outperforming their US equivalents, the last decade shows that these periods of outperformance are usually short-lived. Europe's equity markets have often struggled because it generally lags the US recovery, and then when it's about to take off, the US is often starting to slow down, and that caps the potential upside for other global assets like European stocks. In the US, the bank index has recently made a new all-time high, but in recent sessions, we've also seen banks selling off even when yields have been higher. Some of this is due to earning disappointments, but it also signifies a market that is struggling with the current transition to higher yields without the growth to match. Therefore, the current rotation into cyclical assets could be coming at a time when the US economy is starting to transition into a soft patch. Now, that doesn't mean that there'll be a recession, but it does suggest that the Fed is behind the curve and moving into a tightening mode at a time when assets and the economy are vulnerable. But the main difference between today's tightening cycle and previous cycles, such as 2014 to 2018, is that the Fed's perceived mandate back then was growth, whereas today it's shifted towards price and capping inflation, which means they may have no choice but to tighten. And recent comments out of China even suggest that the rest of the world is not yet ready for a US tightening cycle. But it may require a global slowdown for the Fed to shift its stance again. So far, headline stocks in the US have remained relatively robust, and despite recent volatility, are still near their all-time highs. But there is a risk that retail investors may be forced to unwind some of their positions. They've been instrumental in taking the US equity market to new highs, with the explosion in call options activity nicely mirroring the rise in the S&P. Much of this, like the increase in leverage and margin accounts, is coincident. But we also know that inflows over the last 18 months have exceeded the total inflows over the last 18 years. Whilst these inflows are unlikely to turn negative anytime soon, equity markets tend to be vulnerable after these inflows have peaked and then started to reverse. Therefore, although the Fed is still in easing mode at this exact point in time, they will soon end QE within the next couple of months. Yields are rising into the end of QE, which historically is the point where they and the economy often roll over once again. So once QE ends, the Fed is unlikely to be able to achieve its current goals of rapid rate hikes combined with QT without increasing market volatility. During the 5 years of the previous tightening cycle, the Fed relented on numerous occasions. But what really matters is how quickly the Fed can return to a growth mandate from its current focus on inflation. Markets remain vulnerable in the meantime, but the speed of the proposed tightening this year could itself be the very catalyst that puts their policy back into reverse. And if you have any questions about this episode, financial markets, or the economy, please put those questions into the comments section or send them to tbc@refinitiv.com.